This is part 3 in the series where I'm teaching you how to go about trading options in the stock market. Now, if you haven't seen part 1 or 2, I'll link the playlist in the description below. But today I'm going to be covering what are known as the Greeks when it comes to an option contract. Now, you need to have a understanding of how these Greeks are going to play a role in the profitability of the specific option contract which you are buying, based off of the way you're trading and based off of, well, what your actual intention is behind taking that trade. So with that said, let's hop right into it. Now, what are Greeks? How do they work? And how are they going to affect how you're able to make or lose money on that option? Before we get into that, I just want to go over the bid and the ask again. So the bid is what buyers are willing to pay for the option contract, and the ask is what sellers want to sell the contract at. So in between $12.10 and $12.95, that is the spread. Now, this is a pretty large spread. So when you're trying to get filled, you see the little slider right here. You want to choose somewhere in between that price. So maybe somewhere like 820. So it just depends. And again, these are in the money calls, out of the money calls, in the money puts, and out of the money puts. All right, I'm going to use this contract for the example. We've got Delta, Gamma, Theta, and Vega. So Delta is 61 cents, so $61. So think about it like this. If Microsoft moves up $1, this $11.25 contract is going to go up by 61 cents. Same thing applies to these contracts, except Delta is now 65 cents. So every time Microsoft goes up $1, these contracts are going to increase by 65 cents. Again, this applies to all brokerages. You just might have to figure out where the Greeks are actually listed depending on which brokerage you're using. Gamma is not as important, but it follows, or it's almost connected to Delta. Now the second dollar move, if Microsoft moves up another dollar, it's gonna add Gamma. So Gamma right now is 2 cents. All right, let's use this contract as an example. So it currently costs $12.95. So the first dollar move is going to add 65 cents onto these contracts. The second dollar move is going to add another 65 cents, okay? But this is where Gamma comes in, plus 2 cents, so plus 0.2. So now the contract's going to be worth $14.27. I'll give you another example. If we look at the $9.85 contract, it's going to be $9.85 plus, let's look at Delta. So $9.85 and Delta is 56 cents, so plus 0.56 plus another 0.56, right? So that's going to be the second dollar move is going to be Gamma plus 0.2. So now these contracts are going to be worth $10.99 on the second dollar move. I hope I simplified Delta and Gamma enough. I know that can be pretty confusing, but let's move on to Theta. Now, Theta is the most important, in my opinion, out of all the Greeks. So every day it's going to cost you a certain amount to hold that option. So if we look under Theta and we're going to look at the $12.95 again, for the $12.95, every day that you hold this contract, it is going to cost you 11 cents. Okay, so $11 every day to just hold. This is not really going to happen, but if for some reason Microsoft opened up the next morning at $222.42 and it did not go up at all, you're going to lose $11 of the value of that contract. But if Microsoft goes up, it's going to equal out and you're going to end up either breaking even or you're going to make money depending on how much Microsoft goes up. But if the stock goes down, you're still going to be paying Theta and you're also going to be losing whatever value that contract lost due to the decrease in stock price. So going back to earlier when I said I always choose options contracts with a further out expiration date, well, this mainly has to do with Theta. Okay, if I look at a closer expiration date, let's look at the January 8th calls. So for these calls, Theta is going to cost 23 cents. I've seen Theta be as much as $300 to hold it overnight. So again, it comes down to risk management, managing your risk. When you're playing options, you're not going to choose a close expiration date. You're going to choose something a month or so out. So it's not going to cost you so much to hold these contracts each day. Also, if the stock does not go in your favor, it's going to give you more time for it to get back to that price. So if the value of your contract goes down, because the stock goes down, well, you've got more time to hold that contract and wait for the value to go back up. While at the same time, it's not costing you much to hold it every day. So minimizing risk as you're playing options, that's the smartest thing to do if you're going to play one of the riskiest games in the market. And the last and final Greek is going to be Vega. All right, so Vega is something you're not going to have to really pay much attention to. It's just the implied volatility. So Vega is going to be affected by fundamentals like news. If an article comes out about the stock, that is going to affect Vega, but otherwise Vega, you're not really going to have to focus on it that much. That's everything you're going to need to know. I wish you all the best of luck trading options. Don't forget to do your part in managing risk. Spend a little more money to buy further out expiration dates and further in the money calls. I hope you enjoyed this 3-part series I put together, teaching you not only what options are, but how to go about trading options yourself in the stock market. Now, as traders, we have to answer 4 main questions. What stock are we going to trade? What direction are we going to bet on that stock going? When are we going to be wrong? And when are we going to be right? And I like saying those 4 questions are what I will teach you. I put together a system, a curriculum, and a means for you to learn this lifelong skill of trading, while at the same time, essentially having the ability to follow along and mirror all of the trades that I'm taking myself in the stock market, being options trades specifically. So if that is of interest, I put a link in the description below to my mentorship group, which I actually just opened up a couple spots for. So if you'd like to apply, you'll learn everything else that is included. And if you are accepted, I look forward to working with you and seeing you succeed trading options in the stock market.